Michael, tell us a little bit more about yourself.
Hey, Chirag, thanks for having me. So I used to be an academic, trained as a financial economist, and then later worked in the asset management industry. After having been a mathematical finance professor at Boston University. So my dream, what I always wanted to do, is make financial markets unleash their potential by allowing people optimal risk sharing, optimal insurance, optimal diversification. So to give you kind of an example, suppose you're an automotive worker, and suppose there's a downturn in the automotive industry, you lose your job. It's not great. If all of your financial wealth is also invested in the automotive industry, that's a double whammy. That's terrible. You don't want that. So ideally, from an investment perspective, you would diversify. That's what an asset manager should do. What I wanted to do is bring these things to everybody on the blockchain. And so in order to realize that dream, I first needed to tackle a problem of high trading costs. So I needed to create an exchange which would make it impossible for toxic traders to play their shenanigans, to drive up the costs for you and for me. And Krypton is that solution.
Now, something that's been trending for a while, and obviously in the last few months, is the concept of MEV. And as you were talking about your background in traditional finance, am I right to assume that MEV comes from traditional finance? Can you talk a little bit about that?
So that's an interesting question. Mine extractable value, just very simply put, is that on blockchains, because of the way that miners or validators more generally come to consensus, allows for a reordering of transactions. So if you are a miner, you have a privilege to determine what goes into a block and what the order is that transactions go into the block. Now, traditionally in Bitcoin, where the transaction typically is, I sent you Bitcoin, you sent me Bitcoin, the order in which this happens doesn't matter. For trading, which is something we can do in smart contracts, it does matter. It actually crucially matters. And so in traditional finance, the need for speed, the vying for low latency, is a phenomenon that's well understood. So it comes out in two flavors. If you know what someone else is going to trade, if you have some knowledge of impending order flows, which of course on blockchains we all do because we can look into the memory pool. And then in traditional finance, institutions can just pay for order flow. So you can do front running. The second way in which this comes out is, suppose that you are a statistical arbitrage hedge fund and you get a public or semi-public signal that you run through your wonderful neural networks, and you just realize, maybe 5 seconds before everyone else, that something that's traded for 100 is actually worth 110. You can use that information, that short-lived signal, if you're able to get your transaction, to put your trade in first. And so mine extractable value is not something that exists in centralized finance, but there is an equivalent to that. Mine extractable value is how the incentive to be first is brought out on blockchains. But this incentive to be first exists and has always existed in traditional finance. If you are first, even by a few milliseconds, then you are able to exploit the entire value of a certain opportunity. And likewise on blockchains, if you're first, if you can get your trade in at a lower transaction index, you get to take advantage of the entire opportunity, whether that's front running or whether that's monetizing a short-lived signal. So there's this parallel. What we did with Krypton is to devise a conceptual mechanism that's new and that will simply make it impossible to monetize information advantage, where being first just does not matter. It's immune to these shenanigans.
Right. And going deeper a little bit into that subject, what is the big picture for the trader? How does Krypton and the infrastructure that you are building and you're innovating on to overcome the complexities and the the limitations of the infrastructure, how is it going to create better DeFi opportunities?
That's a great question. And so we're looking at two parties, right? We're looking at directional traders like you and me, or I guess the 99% of traders like a portfolio manager, pension fund manager, mutual fund manager, family office, university endowment, and retail like us. These would be the directional traders, right? And then on the other hand, there are market makers, liquidity providers who give us immediacy. And both of these parties are currently being exploited by what we call toxic traders, toxic order flow, or predatory trading. And so what we analyze with Krypton is that all of these shenanigans are enabled by one single factor that all existing exchange mechanisms share at the moment. And that's the fact that there are only two distinct trading speeds in existing trading mechanisms, either 0 or infinity. Whenever two orders can be matched, the maximum quantity that can be transferred is being transferred in a single instant, which makes for infinite trading speed. If no trades can be matched, trading speed is 0. That single fact means that it pays to be first. If you can just be one transaction index earlier, or if you can be a few milliseconds earlier, then you get to be able to extract value. Now, on Krypton, we just decided let's not do that. Let's never transfer any value at any particular point in time. So what we do is we transfer value as continuous flows over periods of time at finite trading speed. This trading speed is the outcome of a market equilibrium where buyers and sellers formulate their need for urgency. If you have a short-lived signal to monetize against the market maker, then you have to show your hand. The market maker and everyone else will see there is a jump in price and an associated jump in trading speed. So someone, for whatever reason, needs to trade very fast because the signal is short-lived and is seemingly willing to pay a very unrealistic price. That's a dead giveaway that someone is trying to monetize information against the market maker. In this situation, the market maker can simply widen their spreads, reduce their trading speed, and wait until the dust has settled and see what's what. And so if you think about these situations where in a very short amount of time, a lot of price-relevant news comes into the market, these are the most dangerous situations for market makers. And when they get ripped off, they need to make all that money, all these losses, back from us, from the normal traders. That's why they set a bid-ask spread. If we can protect themselves because they can react before the damage gets done, then they can comfortably charge a much lower spread, and it makes trading cheaper for you and for me. Now, the other effect is, if someone were to see your buy order, and they would try to front run, they would get in at an earlier transaction index in the same block. But it wouldn't help them because Krypton is this flow-based trading mechanism. So both of these trades, your trade and the toxic trader's front-running trade,
right,
are recognized by Krypton as having started at the same point in time. On Krypton, everyone who trades at the same time trades at the same price. So they would be moving the price against them as much as they would move the price against you, nothing gained. Krypton is simply immune to toxic trading, and that's something that makes it so attractive.
Right. And let's talk a little bit about toxic trading, because many folks may not understand that concept. The way I understand that is the market maker has to protect themselves from a trader who has more information.
That's right, yeah.
And now, in terms of talking about the entities involved, the market makers, etc., can you talk a little bit about incentive misalignment in DeFi, and is that a concern?
That's actually a pretty big problem right now. And so I'm just going to go back to that simple automated market maker design that has become so ubiquitous in DeFi. On automated market makers, the information about prices is brought in from the most toxic party whose incentives are diametrically opposed to those of the liquidity provider. This is one of the reasons why those costs are so high. And I believe it's one of those reasons that if DeFi is to grow, we need to switch to completely different structures. We need to switch to fully symmetric peer-to-peer designs like order books. Now, it turns out that the classical central limit order book that is used, in traditional finance, on New York Stock Exchange, on NASDAQ, that's also predominantly used in centralized crypto, is unfortunately prone to minor extractable value as well. If you're not on a blockchain, if you are on a centralized exchange, you have to trust the exchange and not front running you. If you're on a blockchain, then typically miners do that, or they sell that right to the highest bidder via a protocol such as flashbots. None of these things are great. That's why we needed to rethink the way we structure this. So we do have an order book, but a new type of order book in which it is simply not possible to front run and in which it's simply not possible to rip off the market maker.
Right. So now let's talk about, the opposite aspect of that, where the market maker with an order book, especially for low liquidity tokens, could they be, for example, have misaligned incentive with an Oracle provider that they could be working with to really rip off the trader?
Oh, absolutely. So the lower the liquidity gets, the more the problem exists of an information asymmetry. So if you use a price oracle, if you use a data oracle, you have to make sure it's decentralized. You have to make sure that the incentives are not misaligned. There's no one who reports data points who also has an interest in misreporting data points. That's of fundamental importance. Now, of course, Chainlink is much more powerful. It's much more universal. It's not only just price feeds. It can also be used for decentralized off-chain computation and, of course, for cross-chain messaging. And indeed, what Krypton does is we use it for our computation use case. Krypton is an order book exchange that features price discovery, does not need to import any prices from anywhere else. And what we indeed did is we realized that Chainlink oracles, the way they were, could be used for decentralized computation. The technology we invented is now patent pending, and it can be used for many, many other applications as well. And it's all powered by Chainlink.
And talking a little bit more about that from an off-chain computation perspective, that's an area that I think is very, very powerful for DeFi, because you can really do a lot more computation, and there are limitless possibilities when you combine the power of off-chain computation to support your on-chain smart contract codes and behavior. So could you talk a little bit about how Krypton leverages the Chainlink off-chain computation aspects?
So with Krypton, we do have a very economically efficient mechanism which leads to low costs for the good guys, for market makers and for regular traders. However, the problem is that it is so computationally intensive that no blockchain in existence today would be able to handle it. So what we're doing is we are running our matching engine and the order processing off-chain on Chainlink's Oracle network. And that is something that is possible because Chainlink has devised this Turing-complete infrastructure that allows us to do whatever we want. Our philosophy is that we're using the blockchain only for commitment. That means making trades or canceling trades, and for settlement, meaning transferring ERC20 tokens.
Right. Going a little bit back about when we were discussing about information asymmetry, about incentive misalignment, and how Krypton has come up with very unique and novel ways for which you've applied for a patent as well. There are some solutions out there, for example, trade execution strategies like TWAP and so on. Could you talk a little bit about that? Why are they not enough?
If you think about what's happening in the world of TradFi, right? The same problems, of course, have existed for a long time, especially in electronic trading that came about in the 80s and 90s, and that's what really gave rise to the high-frequency traders. And so there's currently an arms race underway where the good guys are trying to devise very smart order splitting strategies in order to mitigate the effects that are coming from toxic traders. On the other hand, the toxic traders are trying to infer the intention of portfolio managers who want to build up a position and liquidate that position. And that's basically kind of the struggle that TradFi has been in. Now, if you are splitting orders, say in a TWAP or something like that, you're still executing little chunks of your trade at infinite speeds, instantaneously. So invariably, all of these little trades are inheriting all of the inefficiency that comes from the trading mechanism. What Krypton is a new way of trading. The flow trading order is the way that the exchange works at its very core. There is no other way to trade. It's not just another order type that's overlaid onto an existing liquidity source. So it forces toxic traders to show their hand, to demonstrate to the market that they need to trade fast. This signaling of urgency is something the market can interpret and can react to appropriately. And it is the first time that anything in decentralized finance is not just as efficient as traditional finance. It's the first time that it is even more efficient and less costly.
Makes sense. And I believe your off-chain computation architecture is decentralized?
Yes, absolutely. It's run on Chainlink's decentralized Oracle network.
Michael, what's the end game? In terms of MEV, do you think they'll ever go away? Do you think they'll still exist? What do you think?
So it's a good question. For Krypton, we found an application-specific solution to MEV, specifically for the world of trading. We address mine extractor value comprehensively because we have a solution that tackles the problem at the root. It is a problem that exists regardless of whether you are in a blockchain space or in a traditional finance space. It's technology agnostic. And so we found an economic solution to that economic problem. Now, speaking more broadly about mine extractor value, in all other applications, solutions would need to be found. But we believe that trading is likely the most high value use case for blockchain. And what that allows us to do is actually to go beyond spot market trading, to go to the trading of derivatives, where the problem of information-based trading and exploitation of market makers is even stronger. Typically, in derivatives markets, an order of magnitude more trading volume is processed every single day. And it requires much less capital to monetize an information advantage. But it also gives people the opportunity to optimally share risks and to hedge. Once we've done that, we're going finally to the vision I had 3 years ago to create a decentralized asset management protocol that's completely auditable, completely verified, that's trustless, and that trades at very low costs and allows financial markets to come into their own and allows us this wonderful dream of optimal diversification at very low cost.
Makes sense. With the Bitcoin ETF news, with a lot of momentum behind tokenization, traditional assets, financial assets coming on chain, you are somebody who's an expert from traditional finance background and now solving these hard problems for DeFi. What do you think are the pieces we need to solve to bring more financial assets on chain and to grow DeFi?
So I think that there will absolutely be a convergence of TradFi and decentralized finance. I believe that in 5 or 10 years, most of the value will sit on blockchains. Most of the value will be tokenized. There are some questions around regulations that lawmakers and regulators have to figure out. I'm very confident these things will be figured out. I think the biggest impediment to tokenization of real-world assets is that all trading mechanisms, known and tried on the blockchain up to now are very, very costly, and it would be punitive. It would not make sense for institutions to trade on blockchains. Up until now, Krypton is the solution, I think the catalyst, that will finally enable this new world to exist.
Awesome, Michael. Thank you for speaking with me today. I definitely enjoyed the discussion and wanted to wish you the best for Krypton.
Thank you so much, Chirag. Thanks for having me.